Alli McCartney is a managing director of UBS's Private Wealth Management. Alli, thank you for being here. So tech is a tricky one. I was looking at best performing sector since the end of the last quarter. From here, when you say selective tech, what do you mean?
So you have to play the AI trend. The best thing to do right now in, I think, any sector is to play those parts of the sector that are going to be driven by the secular themes, not just the day in, day out volatility that we're seeing, right? And so obviously NVIDIA tomorrow is a big deal. It's a big deal because it's NVIDIA and it's always a big deal. It's a big deal because we've been in a risk-on environment. You saw this week, the sort of wobbliness in the fixed income markets globally seems to have found a bottom. We have some progress on trade, not only trade with the U.S. and its counterparts, but maybe with the EU and China. NVIDIA is going to bring into that another dynamic, I think, which is that not only are people going to be looking for confirmation on the AI secular theme in terms of what are they seeing from their own build-out and CapEx build-out and data centers from their clients and their competitors, but you're going to start to understand what they're seeing and experiencing in China, which is about 15% of their revenues. So that's going to be interesting.
If you're investing on a thematic basis, AI and so forth, does that suggest in the current environment it's better to have a longer-term horizon when you are making these decisions? And if so, how far out are you looking?
Yeah, well, look, the beauty of what I do and the investors that I service, and largely in wealth management at UBS and any firm, we focus on that long term. And so, yes, in an environment like this, it is specifically helpful to have that environment, right? Fast money, what we're hearing right now, which is probably why you're seeing a little bit of a pickup today, has really not been a buyer, right? They sort of have fixed the selling. They're a little bit balanced, but they're looking for another catalyst to get us up. Right now, what we're finding is that we've had some great opportunities, both on the index basis and on individual stocks and sectors, to get in for the longer haul. It was a shorter window than we expected, given we did not expect a V-shaped recovery like we've had post-pandemic, given everything that's happening with trade. But, right now, we still think we'll have some opportunities. And what we've seen in the past is when you have extreme bouts of volatility or sort of up and down, and we've quantified that from a data perspective in terms of when the VIX or the S&P volatility index hits over 30, we tend to have outperformance in the next 12 months. So if the S&P usually performs about 8 to 10% a year, that number tends to be 15%.
Which is why you just raised your S&P 500 target, I assume. Because a month ago, we were all doomed, right? You remember that?
Liberation Day.
It was like 82 days in April.
Yep.
And every day the markets fell 1,000 points. I think somebody I know hosted a special on a Sunday night. But yet, when you look at a lot of these internal trends, as scary as they were, the data that you guys have and some other providers have show that for some reason, maybe you can answer why, when markets do that, they tend, like 1987, to come roaring back. Do we know why?
I think so swings in markets have always, and this was before algorithms and the way that we trade now technologically, but there tends to be, you sort of over purge at the bottom and then you overbuy at the top. And there are these major swings that you see. And I think those get exacerbated a lot by the fast money and by the short covering that you see and so on and so forth. In the last number of months, in those days that you're talking about, retail has actually been a consistent buyer. It's largely been institutions that have sort of been off the sidelines. But, this has been a really quick paced recovery. And although there's good news, and we did raise our target, largely because we went from expecting 0 earnings this year, so flat earnings, to up 4%. And you've seen what happened in the market in the earnings season that we had. But there are definitely still reasons to be cautious.